All right, everybody, welcome to today's accounting design project. Today we have Martin Kapons from Insia to talk about the fourth quarter earnings effect. Martin, the floor is yours.
Great. Well, thanks so much, Ayung, for the kind introduction and for having me presenting this paper. That's very much appreciated. And thank you all for joining this talk. So all comments and questions are highly appreciated. This is joint work with Ollie Binz from ESMT, and he excuses himself. He cannot join because he's teaching at the moment. So the title of the paper is termed the fourth quarter earnings effect, right? And I hope I don't have to convince you that earnings are important for valuation and stewardship. I have listed some papers, but this is of course not the entire list that make this point. And there's vast literature on understanding the earnings process, accruals processes, cash flows, etc. I think what we don't necessarily know per se is how quarterly earnings work within a fiscal year. Okay, certainly there's vast research on quarterly earnings, but how they behave within a fiscal year, we don't systematically understand. Let's first talk about what we know, right? And of course, quarterly earnings provide, by definition, information on a timelier basis than annual earnings, and they elicit strong investor reactions, implying that they are value relevant, right? And this literature in the 70s and 80s, they focused indeed on time series behavior of quarterly earnings and mainly looked at, Box-Jenkins procedures. So what are the autoregressive coefficients and moving average coefficients on these quarterly earnings time series, but mainly also did that by seasonally adjusting or consecutively adjusting earnings, and mainly reporting forecast errors. Did that by fiscal year, and there we already documented that forecast errors are higher in the fourth quarter, right? And also from this literature, we know that investor reactions are different for unexpected earnings for different fiscal quarters. For example, Salomon and Stober find that there's a muted market reaction to the fourth quarter when we have negative earnings surprises, right? And coming further into this theme of the earnings process within a fiscal quarter, this Francis, Hannah, and Vincent paper documents that special items and impairments are concentrated in the fourth fiscal quarter. And we know from Basu, Huang, and Yang, 2005, that in loss firms, quarterly earnings are lower in the fourth quarter. And they attribute that to auditor conservatism. The intuition being here that auditors have more legal liability in the fourth quarter, when the annual audit is due, and therefore pushing firms to adjust their accounts to be conservative, so to adjust them downwards. Okay, so what we're saying is this quarterly earnings process within a fiscal year has not been systematically studied, and this is the aim of the paper, to explore this. Okay, so what does the quarterly earnings patterns look like, and what may be reasons for the documented patterns? And this is basically over our sample period, the pattern that we observe. There are large downward spikes here in these red circles, and these are the fourth quarters. Okay, and we see quite persistently over our sample period from the 90s to now that we have this, what we call fourth quarter earnings effect, lower earnings in the fourth quarter. We, of course, also see some time trends. So if we standardize that by fiscal year, this effect becomes much more stark. Okay, so we see that these are basically the summary of the key results, that firms report lower earnings in the fourth fiscal quarter than in interim quarters. We've just seen that this is persistent across time, and also across the cross-sectional earnings distribution. So if we, estimate quantile regressions, we can see that this is quite persistent over the conditional earnings distribution. Of course, in the lower tail, it is more stark than in the right tail. Of course, one concern is that, we want to hold seasonality within a fiscal year constant. So we control as best as we can for business environment seasonality, okay, by taking in here industry month year fixed effects. And we also control for cross-sectional heterogeneity across firms, because we want to study the quarterly earnings within a firm. So we also control for firm fixed effects here, right? Then we split our earnings into revenues and expenses, and also want to find out whether this is due to real business operations in the fourth quarter. So we look at cash flows, right? Or whether this is because of some estimates, namely accruals, namely here accrual expense estimates versus working capital accruals. And we find that the effect is concentrated in cost of goods sold and SG&A, and also special items, but the economic effect is much bigger here in cost of goods sold and SG&A. Okay, and it concentrates in accrual expense estimates and is absent in cash flows. When we also do a split on the size of the firm, you can see that it's really, really concentrated in smaller firms. Okay. Now, we cannot really pinpoint one reason why we see this effect, right? So we look at 4 basic explanations: auditor conservatism that I just talked about. We look at earnings management. We look at the US GAAP requirement for interim reporting, which is the integral approach as an explanation, and accounting system quality. Okay. Triangulating the findings that we have is that the fourth quarter earnings effect is most consistent with low accounting system quality. The intuition here is that accounting systems do not work in a way to track complex, accrual expense estimates, and firms may not plan accordingly, and therefore that leads to large true-ups in the last fiscal quarter. Okay. Now we also then check, does that matter to the capital markets, right? And we find that analysts and the stock market does not fully account for the fourth quarter earnings effect. So we of course already know that analysts, as I just alluded to in this quick literature review, analysts have larger forecast error in Q4. So that is not a new result. But we can see that this is really concentrated in expense estimates. If we imply an expense forecast by taking the difference between sales forecasts and earnings forecasts in analyst forecasts, and we can construct a hedge portfolio based on the reversals or non-reversals over earnings announcements. Now, yes, please, Ayun.
Hi, Martin. Is it a good time?
Oh, yes, please, anytime.
So I'm wondering that I think the concentrations of these lower earnings in cost of goods sold and SG&A, is it possibly driven by inventory write-downs in cost of goods sold and also PP&E impairments, potentially depending on the classification? And unfortunately, in the public disclosure, companies may not separately disclose those write-downs and impairments due to the materiality threshold, but you can kind of interview some firms or their auditors that potentially those asset impairments or write-downs are only assessed on an annual basis, especially for smaller firms, because it's quite costly to go through that every quarter.
Oh, yeah. Yeah, no, great point. Thanks for that, Ayun. We were also concerned about that. Also, like how, cost of goods sold and SG&A are constructed by Compustat. what we did, and I think we report that in an appendix A or B, where we have all these items that are included in cost of goods sold and in SG&A. So I think in cost of goods sold, there are some write-downs are included for R&D and for oil and gas, for the oil and gas industry. So we try to, make sure that this is not driving the results by excluding those industries, and the results still hold. And also, especially given that there may be also some R&D write-downs in there, we also check whether, the result is not driven by firms that have high R&D to assets, for example. And this does not seem to be driving the results. We cannot fully rule it out, but, we try to do the best possible that we can, given the definitions that we have based on CompuStat.
I have a quick question.
Yes, please, Jim.
The one thing that seems to be missing here, and maybe it's my ignorance, but there's a large literature in taxes on the tax expense, and that the fourth quarter is unique when it comes to the accounting for tax expense.
No, great. Great that you spotted that. I have not put that in our literature review, but we have checked that. So basically, when we estimate our regressions that I will show you in a minute for tax expenses, taxes are also higher for the fourth quarter. However, if we use pre-tax income, the results still hold. So it does not seem to be driven by taxes, right? And the fact that we find it for those expenses here gives me also some confidence that this is not entirely driven by taxes. One related point to yours, Jim, is that there are some papers that say that CapEx is higher in the fourth quarter, also because of tax reasons. But that also implies that depreciation may be higher because you have more investment in the fourth quarter, and therefore, they may already be written down there. And we see some results consistent with that in the depreciation expenses, but they are very, very small. But point well taken for tax expenses. I think we have already somewhere.
In my mind, that's sort of the conventional wisdom. And of particular concern, and this I think has been researched in the tax literature, is when you have to deal with losses. So the fourth quarter get unique aspects due to losses and taxes. That's sort of I think that's a fair statement of the popular wisdom. I checked with AI, and that's what they claim.
Great. No, thanks. Maybe we can extend this discussion on the tax point. We have at the moment buried in a footnote, but certainly can make this more
taxes and losses.
Thanks, Jim.
Yeah.
Stephen?
Yeah, just to add to the conversation here, there's a question for the cost of goods sold, LIFO versus FIFO, right? It's a bit surprising because actually the fourth quarter for many American companies, particularly retails and many other companies, is the Christmas quarter, okay? Where but then you may have a lot of purchases here of inventory within that quarter where LIFO comes in and hits you. So have you looked at the LIFO, split them up on LIFO versus FIFO?
No, we haven't done that, but we could see we could do that. Yeah. Thanks, Steve. Yeah. Absolutely. Let me just write that down. Perfect. Okay, so far for the summary slide. And Jung also asked me, how does our paper fit into the accounting design project mission? So I had to recall the mission on the website, and it basically says, the project seeks to understand what is good accounting and bad accounting. So evaluating and designing accounting for users, whether it be different stakeholders, investors, equity or credit analysts, management, broader constituents, right? We think our paper is important because we document that there are adjustments to accrual expense estimates in the fourth quarter, right? And that implies that quarterly reporting may deviate from economic performance here, right? So For the subsample of firms that have low accounting systems quality, quarterly reporting may be more noisy. Therefore, that may be a cost to quarterly reporting. This is how I see how it fits into the accounting design project mission. Good. Well, the paper is very descriptive, right, and explorative. So let's dive into how we basically design our study. Yes, please, Wakar. Thanks for
Hi,
joining. Good to see
Martin.
you.
Good to see you too. Just wondering if this is like a period end phenomenon associated with robustness of accruals. Would a period end adjustment such as this apply globally, such as interim periods which are much longer, for example, for the UK and Europe? Would this still surface on there, or is it a quarterly phenomenon specific to the US? Just wondering.
Yeah. No, great question. And I think this goes also into the discussion of the integral approach to interim reporting, right? So under US GAAP, interim reporting is basically part of the entire fiscal year. And as such, those expenses have to be estimated as part of the fiscal year. Under IFRS and also with regards to your question in Europe, here interim reporting is measured under the discrete approach, meaning every quarterly reporting period is a standalone reporting period, right? That's the difference between the two. And one explanation for our result may be that you have to estimate expenses, for example, under the integral approach. Therefore, if you constantly underestimate those expenses in the interim quarters, you have to adjust them in the fourth quarter, driving those results. So to rule out this integral reporting approach was to look at the discrete approach, which was firms that report under IFRS, and we still find results. We only do that under firms that cross-list in the US. That's what we have in the paper, but we also see it for quarterly reporters that do not cross-list in the US. This is for quarterly reporting. That may also be the case for firms that report half yearly, but we haven't checked that. Great. But thanks for the questions. Alina had a question.
Hi, Martin. So apologies if I missed it. I jumped on just a couple of minutes late, but we had a bunch of auditors on campus yesterday because they're our advisory group, and I actually had a conversation with one of them about kind of a similar question that came up in my class, and I said, well, can you just tell me honestly, what is it that you do throughout the year and not at the year end? Because they certainly seem busy all the time, but and essentially he said, it's really what the client wants. And the way that he described it is that he has some clients which make him go through the full close, start not after the fiscal year end, but he said in the first month of the fourth quarter, they will have us do, because they don't want to be caught, surprised essentially at the, with the weeks before the earnings announcement. So he said they'll have us do the full close in the first month of the fourth quarter. And some clients don't want that essentially, but I said, well, does anyone want that in the third quarter, in the second, etc.? And he said, not really there. They just kind of, they use us as advisory more than anything. We do some periodic. So it certainly, it seems like, and I'm hesitant because I don't have a good suggestion to give you, but there seems like very much client-driven heterogeneity, which probably would come up in audit fees as well if we're looking for data where small firms can't afford to do this. They're caught more by surprise because they can't, if they do this at the last minute, there's not a lot of actions they could do. So what is the role of the auditor, and particularly the fact that the extent of their work is different for the fiscal quarters and the fourth quarter, but also seems to be client driven in terms of the, how much of a surprise and how much the final number and the final adjustments will be different from maybe what's expected.
Yeah, no, thanks, Alina, for that question and for asking that yesterday. So this is why we also cannot rule out some of the or really pinpoint it to one explanation, right? So we have to triangulate our results here. So there's one explanation, which is auditor conservatism, right? So the auditor having more legal liability for the full year audit pushes firms to be more conservative. Okay. However, you're now saying that that might also be client-driven, right? And for us, the client-driven explanation is that they may have not much investment for accounting systems, right? And therefore persistently have bad estimates that they have to clean up in the fourth quarter. Of course, these may be the firms that then ask auditors to come there in the first month, but this is something that we unfortunately cannot observe. But this is certainly something that we can think about more. So thanks for the question. Sanjay, please. Good to see you.
Hi, Martin. Hi. First of all, nice paper, very informative. Can you hear me?
Yes, I can.
Okay, yeah. So first of all, I wondered if the paper should be called, based on this slide, fourth quarter earnings or fourth quarter accrual adjustments. Because even though you mentioned it's COGS and SG&A, it seems that the accrual effect seems a lot bigger. And the overall story seems to be that in the fourth quarter, firms clean up things. Whatever is driving it, that seems to be the case. Would legal liability matter? I don't think you did anything in that direction, but if they're cleaning up, are they more worried in the fourth quarter? Have you considered that?
Yeah, I mean, we use a very, very crude proxy for public scrutiny, which is, you can argue that larger firms face more public scrutiny, and firms that, for example, also are followed by analysts. And we actually see less of an effect in big firms, right? So that may play a role here as well. Certainly, yeah. And we could use more direct proxies for that as well. Yeah. And as for your first point, I mean, given this stark figure that I showed you for quarterly earnings, I would call it quarterly earnings, fourth quarter earnings effect. If you want to call it accrual estimate effect, that is fine with me as well.
Thank you.
Thanks for all your questions. Ayun, please.
Hi, Martin. I just have a follow-up after Alina's kind of conversation with you. So on your next slide, I appreciate that you talk about the implications related to ADP's mission. And recently in the US, there's kind of like a discussion about whether we should reduce the frequency of a reporting from 4 quarters to kind of semi-annual. But I feel like your result potentially can be interpreted as there's some costly auditing or verification tasks that can be only done on an annual basis, especially for companies with financial constraints, smaller firms, right? So regardless of the frequency, as long as that frequency is actually within a year, you always have a fourth quarter effect. Even we have a semi-annual reporting, you still see those costly tasks being executed only once a year, because that would be kind of like how much resources smaller firms, constrained firms are able to devote it to, right? So like, I want to kind of push you a little bit about how does your results actually will have implications for the frequency, within year frequency reporting debate recently in the US.
Oh, great point. And that also ties back to Wakar's point, right? To semi-annual reporting in Europe. I mean, I have to speculate because I haven't done the test yet on semi-annual reporters in Europe, but I can certainly do that. But if the logic holds true, it should be that for semi-annual reporters, certainly you also have a dumping quarter, if you will, right? So that might be regardless of the frequency, and your point is well taken, that, if there are these discussions to scale down the frequency, that effect might still persist. And then you don't have, 3 interim quarters where you get information from, but like one basically, and the other one might be then the cleanup quarter. Certainly. Yeah. Thanks for that, Ayun. Wakar.
Hi, Martin. I just was curious. You clearly pinpoint it's COGS and SG&A and nothing to do with revenue, so to speak, right? But we have like a, matching regime going on, so they're not matching costs with revenue properly then within the year, so to speak, right? So revenue is robust, but according to your story, the costs are not robust. They're not being matched properly to revenue. So do you think your paper also speaks to cost control or cost allocation or absorption, or how the costs are not matching revenue, which is
Yeah,
fine?
so yeah, no, I mean, we also we can go through the results in a second. We also find that, of course, we cannot perfectly control for sales seasonality, right? So we see that sales are also higher in the fourth quarter, and to really make sure that this is not, we just observe higher expenses in the fourth quarter is driven by the matching principle. We also control for sales in the fourth quarter and find still that, cost of goods sold and SG&A are higher there. So as such, I think we can also speak to what you alluded to matching may not be perfect in this quarterly setting. And for cost allocation, of course, that is, I think, our main story for this accounting systems quality explanation, right? So that cost allocation is extremely hard.
I think you should upplay this. This is a huge implication that, the fourth quarter fails to map costs properly with revenue, and revenue is fine in the fourth quarter. So the accounting system kind of fails or falls short when it's supposed to work the most because of the audit function.
No, thanks. Happy to play it up. Also, what I have to say is that, of course, sales are not do not have to be estimated under the integral approach, right?
Do I understand that there's no fourth quarter effect when it comes to revenues and sales?
There is a fourth quarter effect that sales are higher in the fourth quarter. That may be driven by seasonality that we cannot perfectly control for.
I mean, I think that it might be nice if the starting point is the top line. Do we have a fourth quarter effect with respect to the top line? That seems to me should be the starting point. After you establish that, then you can see much sharper what goes on with respect to the expenses. Some of the folklore is that revenues are manipulated when earnings are manipulated. Some of the folklore is that the focus now turns to revenues. In other words, during the first 4 quarters, to the extent companies want to manipulate earnings, they do not do it in revenues. But when you get down to the tail end of the year, then suddenly earnings management tends to hone in on revenue. So it would be nice to know what happens to the fourth quarter effect when it comes to revenues.
Yeah, no, thanks, Jim. So let me, I think that's a good segue to go into the empirics, okay? And then we can talk about specifically the split between sales and expenses. Yeah. So hold your horses, Sanjay, please. So we use data from Compustat, 89 to 2023. We exclude financials and utility and impute missing observations by these balancing equations. And we use earnings before extraordinary items scaled by total assets. And this holds, if we use quarterly total assets or yearly quarterly assets to not impose any scaling effects, that there are differences of quarterly assets within the fiscal year. So these are just simple summary statistics by quarter. I think this is just nice to see, that we can already see the results without estimating any effects here, and we can see that earnings are, on average, much lower than those of the interim quarters. Sales is a little bit higher. This is probably because of seasonality. Steve said that retail firms have their highest sales in the fourth quarter, and we can see here that cost of goods sold and SG&A are much higher, depreciation as well, but not so much, etc., etc. Okay.
Did you look at the number of shares outstanding at all?
We don't.
Because that's, yeah, go ahead, please. Yeah.
No, my question is, what is the reason why we should?
Yeah, I mean, when they count for options and whatever have you, then the shares outstanding tend to be important. So the question is that the analysts, they care about EPS rather than earnings more than anything else. So it would be interesting to see if there's a dichotomy or to look at dollar amount of earnings or earnings per share.
Yeah. No, these are asset scaled. In our later tests, we look at not earnings per share, but earnings per share times share price. So in a ways, an equity market scaled earnings number. Okay. So, and there we can also see this effect. Yeah. So, and now our empirical strategy is basically to regress from our earnings, our fiscal quarter dummies, right? And without any firm fixed effects or industry month year fixed effects, this year just tests the statistical significance of this line here, right? Because like if we take this difference here, this should be 4.9. And given that, you know, OLS is estimating conditional means, and if we just put in these fiscal quarter dummies, of course, we get this difference here, right? So which is depicted here. This is our basic empirical strategy. We regress earnings on these fiscal quarter dummies. Now we want to account for cross-sectional heterogeneity across firms and put in firm fixed effects, right? And our results still hold. And now we want to control for business seasonality. We do that to include industry month-year fixed effects. What does that mean? We look at one point in time in the same industry for firms that have different fiscal quarters at the same time, right? So a nice example is we have two ice cream parlors, I don't know, in Ocean Drive, Miami Beach, okay? We are both in August, so we have high demand for both of our firms that operate in the same industry. One has the fourth fiscal quarter in that month, the other one has the first fiscal quarter, okay? And although business seasonality is the same, we observe that the one that has fourth fiscal quarter in that same period of time reports lower earnings. This is basically the intuition between the industry month-year fixed effects, and we can see that the results hold if we have only these industry month-year fixed effects or both fixed effects, firm fixed effects and industry month-year. Ian, please.
Just a quick question. What industry classification code do you use? Because
oh yeah, we do quite restrictive fourth digit SIC.
Thank you.
So to just be very strict on accounting for the seasonality effect. Yeah.
If you like, I think there's a question in the chat box whenever you feel.
Oh, excuse me, I hadn't seen that one.
It's by Ali from University of Florida. Ali, do you want to ask your question?
Sure. Sorry, I'm curious. I'm an auditor, or audit researcher, and I'm curious if an alternative explanation is that auditors are doing their job in the audit when it comes to the Q4 numbers versus the quarterly reviews. Is it possible that that interpretation could be that, again, auditors are doing their job, making the adjustments that they need in the fourth quarter versus not really, they're not doing an audit Q1 through Q3.
Oh yeah, absolutely. We're just saying that there might be heterogeneity when the adjustments have to be made. I think that is part of this accounting systems quality explanation, that you may need to do less adjustments if you had estimated your accrual expense estimates in a better way. Okay, but thanks, Ali. Sudipta has a question.
Yeah, so I'm not sure why you use income before extraordinary items, because the contents of that variable have changed over time. So today there's no such thing as extraordinary items. It's been banned by FASB since I think 2014. So if you want to be consistent in your measure over time, you want to use net income. That's more consistent. And you might argue that, you know, using the fixed effects helps, but the time fixed effects only picks up the mean, not the variance, and net income has a lot more variance than earnings before extraordinary items. That's why we run regressions with that. So I think that you really have to be careful in sort of interpreting if you're not thinking about that, because say extraordinary items also tend to pop up more in the fourth quarter.
No, thanks for that, Sudipta.
So-
I think we had played around with the earnings definitions and the results whole. We also do it on IBIS earnings, street earnings, and the results hold there as well. But there, of course, you also have changes across times within firms, even, right, because of non-GAAP adjustments, etc. But we can definitely pay attention to that. Yeah, thank you.
And
Good.
another follow-up, just another follow-up.
Mhm.
You have a particular definition of earnings quality in mind, right? Sort of some sort of persistence type measure. But, you know, like Ball, Kotari, Robin would argue that timely reporting is more important, right? Timely reporting of losses or whatever. So how are you going to sort of say that your definition of earnings quality is better, or that actually earnings quality is not? You know.
Yeah. I think we're not saying that, you know, these earnings, if you have less fourth quarter earnings, then that may be better. Yeah. That also implies, well, the definition that you said, that if you have timely loss recognition, you probably also have those bad news already incorporated in your interim quarters. So I'm not sure whether those definitions are per se different. That makes sense. Okay. Now, this is on the conditional earnings distribution. Okay, we can see the fourth quarter effect not only on the lowest conditional percentiles, but also on the higher ones. But of course, there they get economically less strong here. Coming to what we talked about with Jim here, this is what I meant with, you know, we have quarterly fourth quarter sales effect, in as much as there are higher sales in the fourth quarter, and that might also be because you can just not perfectly control for seasonality. But this higher sales in the fourth quarter is counteracted by those higher expenses, cost of goods sold, SG&A, and especially special items in the fourth quarter. Okay, and then related to this revenue expense matching argument, of course, higher sales might match higher expenses, right? So if we then control for sales here, we still see our results. They are especially a little bit lower for COGS and SG&A, consistent with those expenses being the ones, you know, that are matched with sales, but not so much for special items, which is intuitive, I think. Then we do this split for cash flows and accruals. And accruals we split into working capital accruals, and estimates are just the difference between the two, as per this definition by Lefley and Sugianis. And we can see that, you know, we have higher cash flows in the fourth quarter, and that might be consistent with cash flow seasonality, right? If you recall from last season in the accounting design project, David Wienmann presented a paper that showed there are cash flows that are higher in the fourth quarter that may be driven by flow seasonality, but, you know, consistent with the timing role of accruals. Accruals are lower in the fourth quarter. Okay, and that is economically much more stark for estimates, than for working capital accruals. And of course, given this timing rule effect, we also control for CFO for the accruals, working capital, and estimates regressions, and find similar results. Okay, much with the like the intuition with sales controlling for the expense estimates. Good. Then we do the size split. Okay, we for asset quartiles by fiscal year, and here we can really that our fourth quarter earnings effect is concentrated in the lowest total asset quartile. Okay, we work on certain little bit also by a effect, given that we scale by total assets. It doesn't seem to be the case because you see that sales are quite stable over time. I forgot to mention these are the fourth quarter earnings coefficients. Okay. And for expenses, we see the same pattern that, you know, especially cost of goods sold and SG&A are concentrated in those small firms. Accrual is effect as well, same for working capital and especially the estimate. Okay, so it seems to be driven by our small firms in the sample. Good. So far for our, yes, please, Ayun.
So Martin, after seeing this result, I wonder that all the I think previously you report the average by quarter, but if you report a median, maybe the fourth quarter effect is not a big deal because it's driven by just small firms, right?
Yeah.
And those firms' earnings and different line items with the income statement just by default is more volatile.
No, great point. So of course we estimate average effects here, right? We use ULS, but recall from our, I think, third table, here we also do quantile regressions, right? And here we have the conditional earnings quantile for the 50th, which is median regressions, and we see the effect here as well. And I think we also have descriptively a table 1 panel C, where we also just plot as for our averages, our medians, and I think I still have that somewhere. Oh, excuse me, that is this one here. And here we can also see, you know, for medians, the effect. So it's a great point, of course. Average effects may be larger than our median effects, but we can still see that in the data here as well.
I have a second question. Is that the regression model you have, you seem to actually use first quarter as a benchmark, right? And it is a little bit related to Sudipta asked earlier, like you have a notion of an earnings quality that's can be kind of a unique compared to what people thought about earnings quality. So the way I interpreted it is you use first quarter numbers as a benchmark, and anything higher or lower than that, you will interpret it as inconsistent or not persistent, and then to you, that is not high quality. But if anything aligned with your first quarter numbers by line item, can be cost of goods sold, can be earnings, then that will be interpreted as a higher quality in your notion of earnings quality, right? And I think that is very unique because you can say this is a fourth quarter effect. You can also say this is a first quarter effect because first quarter has been used as a counterfactual benchmark, right? That would be the highest quality, or how you judge the rest of the 3 quarters in your regression. That's how you kind of like design your regression model. I think that would be something kind of talk about what's the benchmark, what's the high quality in your notion before you highlight this anomaly or puzzle. Yeah.
Yeah, no, thanks. And certainly, you know, we had to use a benchmark, and I like you're thinking of, you know, counterfactual. We could of course also use an average of the first 3 quarters as a benchmark as well, right? So just having a fourth fiscal quarter dummy in there. And then, you know, given that our results are pretty low here, economically, the difference between the first quarter and the other interim quarters, that might serve as a benchmark as well.
Yeah, it's very interesting to see the Q2 and Q4 has this negative effect relative to Q1, right?
Mhm.
And it's kind of like somehow got me thinking about semi-annual reporting.
Yeah, no, good point. And I mean, these ones, I'm not sure how to interpret the Q2
Yeah,
results.
Q2,
It
yeah.
holds here for OLS, but you know, if we go for the quintiles here, for example, Q3 is not significant, et cetera, et cetera. So I think, you know, the economic action is just in the fourth quarter here. I saw that there was something in the chat, so I'll just open that. Okay, so Dipta had a point. Small firms may hire auditors for less work in interim quarters. I think that is related to Ali's point, right? That and Alina's point. Yeah, that is good. Thanks for joining, Jill. He has to leave early. And we have Sudipta. First quarter earnings should be affected by reversal of real earnings meant at a year end. That might be the case because, you know, we look at within fiscal year. So we don't necessarily look at carryovers from fourth quarter to first quarter. To me, it is as we just alluded to, you know, if we look at the effects of the second quarter and third quarter, as opposed to the first quarter, that the economic effects are not as large. So that gives me some confidence that we might have a good benchmark. But again, we can just put in a fourth fiscal quarter dummy to circumvent that point. Good. I'll take Wakar's point, and then I will move forward.
Martin, just double checking because I think we can understand a lot more about this puzzle. I mean, I think we have a lot of sense now about auditor probably work, but are there managerial incentives that can clearly be seen that are pushing for this fourth quarter anomaly?
Can you
why
repeat,
would the
please?
like, for example, Ian said that you're working with certain impairments, so to speak, that are manufacturing related or below the line impairments, or some such similar numbers of accruals. Are they driven by managerial pressures to meet targets, to meet covenants? You know, the classic investigation that we do to understand where the accrual pressures are coming from.
No, that's a great point, and that goes back to what is driving it, the explanations for it. I think if you want to meet targets, which is kind of an earnings management related point, is the fourth quarter earnings effect should rather be higher than lower, right? So that might be inconsistent with such type of argument. Yeah, very good. Okay, Alina, and then I will move forward.
So, and I know you mentioned kind of that you think of the paper as descriptive. I think it needs to be more descriptive, but then again, you know, clearly, I love descriptive stuff. So, but I just pulled it up really fast. And again, you kind of talk about accruals, right, as like a general category, but I think you're getting at the meat in the paper. You say, well, this could be bad debt expense or stock-based compensation, or I think that's where you need to go, because I think it's a very different story if this is auditors coming in and saying, you guys are, particularly for small firms, right, you are not in line with what the rest of the industry is assuming for uncollectability, and that's the entire explanation. Or this is them giving fourth quarter bonuses and, you know, it's all equity based. Neither story is more interesting than the other, but it's certainly interesting to understand which one it is. And I think the third you mentioned is the tax, which brings us back to kind of the tax discussion.
Yeah.
I think if you're going in this direction, you have to dive in and kind of say, okay, and that's SG&A for COGS. I can't think of any story other than inventory impairments being in there. Unfortunately, you can't pull that out from CompuStat that easily, but you can do some other, maybe a little bit of a magic with a textual analysis of the 10Ks to see, because there's really no reason for COGS to be systematically if it's an estimation issue. But I think that would be really interesting. I think it cannot be on a high level, because I think we're all nodding and saying, well, yeah, this kind of makes sense, but tell us the specific items, and particularly if there are subgroups for which these specific items manifest differently. I think that would be very interesting.
No,
yeah,
we can definitely.
my 2 cents only.
No,
so.
great. No, great. Thanks, Alina. I'd love to dig deeper. Bad debt expense is, I think, not very much populated in Compustat, so we have to be a little bit careful there. There are some, and I checked that.
But they're
if
populated
the
in
report-
every 10K. Schedule 2 does exist in every single 10K. For again, I mean, it's easy to suggest things when you're not the one who has to do the work, but
No, I
yeah, I
didn't
mean,
mean
we
to be. I didn't mean to be not doing the work. So definitely, it'd be nice to fan that out, right? I'm with you there. As with inventory write-downs, I would be more concerned if our working capital then is lower than our expense estimates, right? Because I would say the working cap, like when we do this fan out here and this working capital here, there the inventory write-downs should be in here, right? Not necessarily in the estimates. So given that this is, it is there, but not as economically large here, that may give me some confidence that it might be the estimates. But again, point well taken. We can dig into this a little bit more. Yeah, very good. We've already talked a little bit about the explanations, and I talked a little bit already about auditor conservatism. Another explanation that Wakar just brought up is earnings management. We talked a little bit about integral approach to interim reporting and this accounting system quality. And again, we have to triangulate here. We haven't found a perfect setting to pinpoint, this is the explanations. All of them might be at play here, right? But it seems like everything is hinting towards that accounting system quality is one major driver. Steve?
Yeah, I'm thinking now you're doing a lot of documentation of where this shows up and so on, but I think that the big question here is the question of earnings management in 3 quarters versus the order versus the 4th quarter. So breaking it down into if you can break it down or think about it in these categories, the 4th why is the 4th quarter different in these categories? Well, it could be because of this overstatement in earlier quarters, okay, which people would be worried about, but also could be quite institutional, okay. It could be first of all, it could be it could be 3 things. It could be that earnings management thing. It could be transaction based, okay. And you did mention capex in the 4th quarter. Inventory purchases under LIFO was one thing you might look at, but it also could be so it could be transaction based. But it also could be institutional. I think Ali was hinting at this. And one thing to think about there is the orders coming in. Okay, so inventory shrinkage. Okay, we're on the perpetual inventory method for 3 quarters, and they come in and say we've got to do a physical stock count. And this inventory shrinkage actually is a big number now. The theft from stores, retail stores here in the US is just alarming. So these would be things to the way to think about it. And many of these things you won't be able to sort it out, get the data to sort it out. But to actually put it into categories, and the ones I think about are transactional, institutional with the interaction of transactions with accounting principles. Okay, so getting onto on the institutional aspects. Can you look at Ali? You might have some significant audit matters, or significant audit adjustments. Okay, do we see these particularly aligned with firms where you've got the big drop in the 4th quarter? Okay, so just think about it in terms of these these transactions, institutional aspects with auditing particularly. And then the earnings management thing, trying to get some handle on that differential. I think that's the big elephant in the room, to tell you the truth. Okay. Thanks,
Steve. No, we can definitely do more in pinpointing the exact mechanism. Let's talk about the ones that had been brought up in the literature as we see it. And we already talked about auditor conservatism, right? The legal liability is higher for a full annual audit than for interim reviews. And auditors push firms to be more conservative in the 4th quarter, which is, of course, consistent with the 4th quarter earnings effect. But we would actually expect the effect to be stronger for large firms that face more public scrutiny. And, you know, we try to also get a little bit more beef on this audit review versus full annual audits, but we could do it only very descriptively on this change of requiring an audit interim review in March 2000. And we basically interact a dummy with March 2000. So this is for, I think, a period 1 year before and 1 year after this mandatory audit review. And we can see that, in fact, the quarterly earnings effect is still there, if not stronger, what we document here around this audit review change. So this is very descriptive because we don't have a control group here. So people like Ali, if you have any ideas on how to get more beef on this explanation for such settings, that'd be highly appreciated.
So the timing is kind of unfortunate because it's also SOX and it's FAS 141, 142 with goodwill. So I mean, a really messed up time period to look at.
And .com bubble, where you might have huge write-downs, right? So we're not claiming anything that the effect might not be here. We just don't have a control group, right? Point well taken, Sudipta, right? We just try to do as best as we can, but like we also did it on a very, very short time period, just around March 2000, and we find similar results, but still, it's not perfect, right? That is for sure. For earnings management, there are several things that might be at play here. So, you know, managers may push earnings upwards in the fourth quarter because of compensation or debt governance that Waqar mentioned, or you may smooth earnings, right? After observing interim quarters. We do find the fourth quarter earnings effect if we sum interim quarters and they're positive, and if the sum of the interim quarters are negative, which may be inconsistent with a smoothing explanation. And we would also, you know, as I already alluded to Waqar, the earnings management explanation might not be consistent with the direction of the fourth quarter earnings effect, right? It should rather be higher than lower. One concern that Steve Penman just mentioned is that actually, you know, you actually also have underestimation of expenses in the interim quarters, right? So you're actually making look interim quarters better than they should be. So one way that we thought might be a way to go about this is to sort firms into high and low discretionary accruals, right? And we saw that see actually that if you have low discretionary accruals based on all the discretionary accruals models that we could think of, the fourth quarter earnings effect is actually larger here for all the ones that we estimated, right? So earnings management might not be as at play, at least for the average effect, right? For integral approach to interim reporting, I will skim through that very, very quickly. We already said that under IFRS, you follow the discrete approach, and therefore this is different. So we still find the effect, and therefore that might be inconsistent. We use revalue data for our accounting systems quality measure. We measure the percentage of business controllers in the firm using this revalue data that uses this employee data, and we see that really there, when we have low amount of business controllers, there the fourth quarter earnings effect is concentrated. And if we use these Gallimore and Labro measures, this holds as well here. So this is most consistent with this fourth quarter earnings effect. I'm running out of time, so I will skip through our earnings surprises for analysts, right? What has been documented is that the fourth quarter earnings effect for earnings surprises is present. What we do is that we imply expense forecasts from the difference between sales and earnings forecasts, and find that the expense effect is here. And the important thing, if we look at negative earnings surprises, fourth quarter earnings, so these are returns around earnings announcement, they reverse as if the content of fourth quarter earnings is not as informative as for non-Q4 earnings. And then, of course, each month you can form portfolios, go long in past earnings announcement that had a fourth quarter announcement, go short on the others, and we find some 5-factor alphas. Positive earnings surprises follow a drift, as has been reported, but this is basically our findings. I just want to thank you and make an important announcement, which is next time. Okay, next time Alan Huang, Shiheng Wang from HKUST, and Bukra Ozil from UT Dallas will talk about the determinants and consequences of financial thresholds and credit ratings. Note that it will be a different time to accommodate our colleagues in Asia. That will be October 21st, 7 p.m. Eastern. So I hope you will all join. Without further ado, I just want to thank you for all your comments. This was really helpful. So thank you very much.